Our first speaker of the day is Sid Norris. Sid Norris has been an active investor, trader, and student of the financial markets for over 30 years. Since 2010, he has provided market forecasts for subscribers at his website, ElliottWavePlus.com. Sid is best known for pioneering new ways to improve the accuracy and usefulness of the wave principle. In 2013, he started integrating Hurst cycle analysis into his Elliott wave counts with the objective of removing directional bias. Over the years, as his understanding of how to combine Hurst with Elliott evolved and improved, his subscribership grew substantially. Today, Sid is best known for taking Elliott wave theory to the next level by combining it with additional robust methodologies, thereby creating higher confidence, less subjective trading forecasts. Over to you, Sid.
Good morning, good afternoon, good evening, wherever you may be. This is Sid Norris from Elliott Wave Plus. And this is my website that I'm showing here. And by the way, thank you, Jody, for that nice introduction. Before we get started, I wanted to show you my website, which is Elliott Wave Plus, and Elliott has 2 L's and 2 T's, ElliottWavePlus.com. And I'd like for you to be aware of my disclaimer. So please, when you have time, go to my site, scroll all the way down to the bottom of any page on the site, click on the Terms of Service Disclaimer tab there, and there's the disclaimer. It's there all the time. If I were to summarize it in one sentence, it would be, there's risk of loss in all trading. Now I'd like to get straight to the charts. I use a platform called Trade Navigator by Genesis. And one of the big reasons I use Trade Navigator is that the Fibonacci tools here will draw in using Similog math. That's critical especially on longer term charts and to set Fibonacci targets. And so what I'm showing you here at the start is my long-term count on the Dow Jones Industrial Average. Before we get into the nuts and bolts of how that was established, I wanted to pay homage to a couple of people that are on today's presenter list. One is Laura, who back between 10 and 20 years ago, I was a subscriber there and learned a tremendous amount of detail about counting waves. And so I want to thank Laura for being an excellent wave counter and teacher going back decades. And I was super happy that today, Jody was able to secure a spot for Peter Goodburn of WaveTrack, of I think is as far as long-term charts, an unsung hero in Elliott wave counting, and an expert going back many decades. But it was in fact Peter Goodburn that in early, I would say in 2010, so that was shortly after the low in 2009, that set Fibonacci targets on the Dow Jones Industrial Average for a 5th wave up that would reach up in the neighborhood of 42,000 on the Dow. So as many of you may recall, if you've been counting waves for a very long time, Robert Prechter, who wrote the Frost and Prechter book, and who kind of rediscovered and brought back into the mainstream the Elliott wave principle. He found an old book by R.N. Elliott in the New York Public Library back in the early 70s, and just really took that and ran with it and made it a thing again. It had really kind of somewhat disappeared from popularity. But the wave principle really was invented back shortly after the crash from 1929 through 1932, the 90% crash there. A lot of people lost their savings completely at that time, and R.N. Elliott went back and manually put together daily and weekly and monthly charts from the Wall Street Journal, I believe it was, and developed the wave principle way back in the 30s. And it wasn't until the early 70s that Robert Prechter kind of brought it back alive. And so those people deserve a lot of credit, but it was Peter Goodburn that in 2010, and it seems so obvious now, called this an expanded flat, a large degree expanded flat, and up from the 1974 low, a 1, 2, 3, and 4, and looking for a fifth wave up. And I have learned, as I'd mentioned, I pay homage to all of the different wave counters that I have learned from over the years. So certainly Prechter, Goodburn, and Laura are on that list. But there was a Fibonacci target that Goodburn talked about way back then, where wave 5, in this case burgundy, wave 5 or primary degree wave 5, that would be the fifth wave up from the 1974 low, would be the best expectation would be where it would be equal to the net traveled of 1 through 3 in burgundy times 0.618 times 0.618, and then add that to the bottom tick in 2009, and that's how this target is derived, 41,981. As I'd mentioned before, this must be done using the Similog chart, and it must be use Similog measurement tools or Fibonacci tools. If you do not have tools that will do that, for instance, if you're on Thinkorswim, you would not be able to duplicate that target. Matter of fact, I will take these Similog tools out of consideration and have them use just standard linear math, and you can see the target for the end of the fifth wave up from the 2009 low would have been right here, 13,370. So that obviously is not correct. And then when you tell the tools to use Similog math, now we have the targets. And there's also some additional Fibonacci targets up here that are worthy of consideration. This one at 41,020 is where the entire move up from the 1932 low to that price, 41,020, where the 1974 wave 4 low would cut that entire distance by the golden section. In other words, this highly extended fifth wave up from the 1932 low, 1, 2, 3, 4, and then the extended fifth wave would be equal to 1.618 times the net traveled from the beginning of the pattern through the end of the fourth wave. So that is at 41,020. Very, very close, really, considering how long this chart is goes back 100 years to the wave 5 burgundy or primary degree target of 41,981. And ever since the 2009 low, I believe we have a very clear pattern to the upside of 1, 2, 1, 2, 3, 4, 3, 4. And now we're in the fifth wave up from the 2020 low, the March of 2020 low. So I'm going to get into the particulars of what I think is happening since the March of 2020 low. And at this time, I think I'll bring over a Hurst cycle analysis of the S&P 500. And Hurst cycle figures out about 20 different cycles and everywhere from 18-year cycle, 9-year cycle, 4.5-year cycle, 18-month cycle, 40-week, 20-week, 80-day, and so forth, all the way down to a 5-day cycle. It figures all of those out at the same time, and it assumes that the troughs, the cycle troughs, will be coordinated. In other words, when you get a large cycle trough, it's going to end a number of shorter cycles at the same time. J.M. Hurst, an American engineer, used mainframe technology back in the 70s to devise this system, and I just think it's pure genius. And part of it is based on the fact that stock markets have a tendency to bottom in spikes, but they have a tendency to top in a rounded fashion. And that is exactly what her cycle analysis is predicting is going to occur over the next few years. So this rocket ship move off of the 2020 low, we'll talk about that in a second, but you'll notice that what her cycle analysis is projecting is it projected the downward movement into the March, or actually October low of last year. And now it's projecting that we are nearing a peak here, and then we're going to move down into approximately April of next year. And that will be a 4.5-year cycle, at the end of a 4.5-year cycle that started at the March of 2020 low. So within each 4.5-year cycle, that's the orange cycle right here, there are typically 3 18-month cycles. And within that 4.5-year cycle, 2 of those 18-month cycles have already occurred. There was one that was quite bullish and ended in approximately November of 2021. And then the second 18-month cycle ended in October of last year. Now we're in the final 18-month cycle within the 4.5-year cycle. And we're about halfway through it. And so it is projected to generally be the most bearish of these 3 18-month cycles as it moves down into a 4.5-year cycle trough. You can see this kind of nest of cycles that's due in approximately February of next year. But then after that, it projects that the market stays up, and moves up next through approximately April of 2025, down through approximately August of 2025, and then ends up peaking in December of 2025. And this, by the way, this orange line is called a composite line. It gives equal weight to the direction of each of those cycles that it is simultaneously figuring out all the time. It gives equal weight. And so cycle analysis, the composite line doesn't necessarily project price, but it does project direction. And it's suggesting that the market will stay up until late 2025 and then be very, very weak after that. This is why I do not believe we have an end to the secular bull market up from the 1932 low. And it's one of the reasons why. The other reason is I've got these Fibonacci targets up here that haven't been hit yet in the Dow, that are anywhere from 41,000 to 43,652. So I don't think we have a market top yet. I think it's going to be rounded, a rounded market top. And moving into the monthly chart, we can see now that the March of 2020 low, according to Hurst, was a very large cycle trough, an 18-year cycle trough. And you can see that it has the market grinding and chopping its way up through that December 2025 high that I just showed you as the projected, peak before it really starts getting quite bearish. in the stock market. And that is due in approximately December 2025, according to her cycle analysis. Oh, what other additional proof do I have, or evidence do I have that the market hasn't topped yet? Well, for that, let's move in the Dow Jones Industrial Average into the weekly chart. On the weekly chart, up from that March of 2020 low, I think that the move, the kind of rocket ship move up that ended up peaking in early January 2022 was in fact an ABC zigzag. And it subdivides as an ABC zigzag: 1, 2, 3, 4, 5 for A, a very quick wave B, then 1, 2, 3, 4, and then the fifth wave was an ending expanding diagonal at small degree. And by the time the market topped in January, or the Dow Jones Industrial Average topped in January of 2022, that pink wave C, A, B, C, was very close to being equal to the wave A in the Dow Jones Industrial Average, a fairly common expectation in traditional Elliott wave, where in an ABC zigzag, it subdivides as a 5, 3, 5 structure, and wave C is approximately equal to wave A. So that target was right here, and you can see how very close it came to that target. If I show you that very same thing on a weekly chart on the S&P, this is where we start getting into some additional Fibonacci targets that Goodburn, frankly, the second speaker today, has been using for decades, and they're not really mentioned very much in the Prechter Blue Book, but I can tell you, I see them working all the time in the markets. And in this case, the ABC zigzag up from the March of 2020 low, wave C, was almost exactly to the tick a 0.618 expansion of wave A. So this would be wave A. And so you figure that as a distance of 1. You take that point times 0.618 and you add that amount to the top of the structure. So this is called what I call a Fibonacci expansion, and use it all the time. For instance, on the S&P, on this initial move down from January through October of last year, if I could consider that a distance of 1 and take that times 0.382, then that gives us a Fibonacci expansion target. And I would say a minimal Fibonacci expansion target. There'd be another one even lower. For instance, we could look for a 0.618 expansion, which that showed up right here. But the minimal expectation for the end of this wave 2 of this ending contracting diagonal would be with the S&P moving down to 3087 next, and basically bottoming there as the next Hurst 4.5-year cycle trough. So within each 4.5-year cycle, there is 3 18-month cycles. There's the first one, there's the second one, and now the third one, and we're about halfway through the third one. And this is strongly suggesting that the peak we just saw a few days ago in the stock market may be, and I'm stressed, may be as high as we're going to go this year in the stock market. And then let me get back to the Dow. You'll notice on the Dow Jones Industrial Average, I'm suggesting that it might have one more peak high. Why would I suggest such a thing? Well, let's look back at the S&P Hurst cycle analysis. Yes, the downward movement that we had started at the beginning of last week, 1 week ago, is expected to continue lower down into an 80 or a a 40-week cycle trough. The composite line is suggesting it'll only go down through about mid-July, but the nest down here of troughs could extend into about a week into August. And then it's projecting that the market would stay up, possibly through early to mid-September, before it gets into the final, and I believe this is when we get a recession, down into April of next year. So once again, on the Dow Jones Industrial Average, moving back to the weekly chart, some addition, once again, to summarize, going back, we have Fibonacci targets in the Dow that had not been reached that are higher. We have the initial move off of the March of 2020 low as an ABC zigzag. That would not be what would happen into a major peak. You need a 5, and the fact that it's an ABC zigzag indicates that is likely wave 1 in blue or minor degree of an unfolding, ending contracting diagonal, and that we're in wave 2 of that contracting diagonal right now. And that wave 2 is rather rough and complex, and that's what the wave 2s of diagonals typically roll. So in an ending contracting diagonal, you get the most aggressive and longest of the odd numbered waves as the first wave. And then many times one of the legs of a diagonal is complex. And so I believe we're in that complex leg now. And that will take us all the way into the first or possibly the second quarter of next year. As many of you know, there's been bond inversions where short duration bonds pay higher yield than long duration bonds, and there's a number of different versions of the different durations of bonds that occur, but the most recent was the 3-month was in October of 2022 was paying higher than the 10-year. Typically, it's really got an amazingly strong accuracy record. When you get bond inversions, you will see a recession fairly soon. How soon? Well, typically a recession is due to start about 6 to 18 months after that inversion. Well, that inversion occurred in October of 2022. So we're in the early part of the window where we would expect a recession to start, but it really doesn't have to start, if it's going to be typical, until March of next year. Well, based on once again on the Hearst analysis, that recession is very likely to occur from approximately September of this year down through April of next year. Of course, that's going to be rough. But it makes sense that we would get a sharp and relatively short recession by the time we get to the end of this wave 2 of this diagonal. So there's the Dow Jones Industrial Average, and right now I think we are in the beginning of a move to the downside into a 40-week cycle trough that is due sometime in late July or early August, due to bottom somewhere in there. Now, in the S&P, we've already seen on the S&P a retrace. Let me see if I can get to the weekly chart. We've already seen about a 0.786 retrace. We've already seen a deep retrace of this initial move to the downside. Each leg of a diagonal is typically an ABC zigzag, like A, B, C, or it could be a double zigzag or triple zigzag. I think that what we're going to get is a double zigzag. So A, B, C, that's the first zigzag for an X. And then the move up in the S&P, a triangle for B, terminal thrust out of the triangle, finished. That would be the X wave. And then we would get another ABC down for a Y wave. And then what we'd end up with is a double zigzag for wave 2 down into the first or second quarters of next year. The movement up also, and this, what this suggests, because this has already moved to the upside so aggressively, is we may have just seen actually the as high as we're going to see in the stock market this year. And there was a Fibonacci target, once again, an expansion target on the S&P. This I've had on the charts for quite some time. Some of my charts around 43.57. And it overshot that by a little bit, but now it has very quickly moved down below that. And that target was derived by figuring that this first 5-wave structure to the upside for wave A in green, you figure that's a unit of 1, take that times 0.382 and add that to the top of wave A, and you get that target, 43.57. So it was overshot by a slight bit, but very quickly reversed. And so I think it's possible that this rise
What do I make sure?
coming up, this
Yeah.
rise coming up from the mid-October low through that high in mid-June. Actually, the rise that I'm expecting based on what the composite line is suggesting from mid-July up through mid-September, that may not make a new high. So once again, on her cycle analysis, the composite line does not necessarily denote price. It denotes direction, projected direction. So this is expected continued downward movement through late July, possibly to early August, and then a move up into mid-September before getting into the stronger move down. Will this make a new high into mid-September, or will it not? Well, for that, we can move back into Elliott wave. And we can use Elliott wave as the deciding factor on whether we would get a new high in September above the high we just saw or not. And the deciding factor is that the question on the table right now, the big question is this move down into late July or early August, is it going to carve out a 5-wave structure? If it does, then we very likely have seen the high for the stock market just a few days ago on June 16. We've seen the high for the year. So I know I've been going back and forth between the Dow and the S&P, and you might remember last time when I presented back in, it was in February. In mid-February was the last Elliott Wave Hub presentation. And by the way, I'm back on my website here. So if you want to go back and look at what I was projecting at that time, you could go to my site and look under the resources tab under blog, and it will be there. And that's the Elliott Wave Hub presentation. During that presentation, and I clicked on it, and during that presentation, I showed my current Elliott wave counts and her cycle analysis, but I also showed a lot of things about my service and the different tiers of service that I have. And I wanted to show you very quickly a couple of those as a refresher, but please go back and look, go that last presentation. I talk about all my different tiers of service and what they include. And this, for instance, if you're at my website and you want to go to, and you're not logged in, you're a new subscriber, or you're not a current subscriber, and you go to learn more about my cheapest level service, the $25 a month service. It takes you to this page, which here's the important thing about this page. You must scroll down. Keep scrolling to see the 4 different levels of service and what are included. Okay, you've got to scroll. I have a lot of old subscribers that like to trade the markets, but a lot of them aren't used to these modern websites where you go to a page and you must scroll to see the entire page. So please remember to do that. That will show you what's involved with the 4 plans. By the way, the $25 a month plan, the only Elliott wave that it shows is on Bitcoin. And so you're not going to get much for $25 a month, but that will give you Bitcoin and it'll give you a few other things, but that's the only Elliott wave. If you're interested in Elliott wave on lots of items, you would need to go to the basic plan. And if you're interested in seeing me present all of my wave counts and everything that, including sentiment and all kinds of things, you would have to go to the Pro plan. And if you're interested in automated momentum signals, as well as really drill down on sentiment conditions across the entire market structure, as well as seasonality, you'd have to go with the flagship plan, the premium plan. So when you click on pricing, that takes you to this page, and this shows you how much each level of service runs. Most people would be highly disappointed at $25 level. I know that's a very enticing price amount, but that's not going to get you much. If you're looking for Elliott wave, you got to go at least to here. And if you want me to hear me explain every week everything that's going on in the markets, including all the sentiment, the seasonality, everything, you got to go at least to here. And I show those in the webinars. Once you're a subscriber, these headings up here become available to you. And once you're logged in, and you can see all, and I show all of my screenshots going back years. And so I hide nothing, and if I'm wrong, I'm wrong. And you can go back and you can look, but for the most part, really, in recent times, thanks to the additional juice that Hearst cycle analysis provides, I really haven't had to change my wave counts very often. And then you can go back and look at on my webinars going back years, nightly reports. You can, if you are a subscriber to the premium plan, you can see those and get an actual executive summary every night of momentum signals, as well as screenshots on a whole bunch of items. There's the executive summary. It lets you know if there's any new signals in the market or suggestions on taking profit or exiting a trade, et cetera, on a bunch of items. So all of that is at my website. I went into all of that with great detail last time. So don't forget, at the blog, you can go there and you can see my presentation from February. And so I've rather than talk about that any further, I'm going to go back now and show a few things from back then. The first thing I want to show you is a screenshot that I first sent out to subscribers in January 10 of 2021. January 10 of 2021. And this is when I first It was the Russell that inspired the idea that we would get an ending contracting diagonal up from the March 2020 low. And the thing that really supported the idea was the fact that it was moving up aggressively into extreme overbought territory in an A, B, C structure. Critical. Also, there was a large degree Fibonacci target at 2727 that hadn't been hit yet, and it would take some time to hit. What I didn't realize at that exact moment, and that was on January 10 of 2021, was how long it was going to take for this ending diagonal to develop. As it turns out, yes, that we got an ABC up for wave one, but the wave two ended up taking us all the way. Is probably going to take us all the way to the middle of 2024. Notice that date, July of 2024, the middle of next year. And notice that that date really hasn't changed much, in the S&P, looking for that 4.5-year cycle trough in approximately April. So it really hasn't changed much over the last 2 years. But what has changed is the wave two of the diagonal has been long, drawn out, choppy, complex structure, and it's going to take approximately 2.5 more years from today to get the end of that very rounded top, the contracting ending diagonal. So I've showed you Hertz cycle analysis and how I incorporate it into what's going on. A couple of other things I'll show you from going back a ways. This is a screenshot of what I was expecting at the time on the S&P. This is a screenshot from March 12th of this year. And you can see I was bullish. I was bullish all the way through May 15th, mid-May. Bullish through mid-May. So it's important to look at the dates as you move through. And then there was a 40-week cycle trough at that time due a little earlier. A lot of these dates have gradually been pushed forward by the ongoing price action, and it's taking a little longer for the peaks and troughs to develop as time moves along. This is not surprising when you consider that we are in this diagonal pattern. Trading inside a diagonal is traditionally difficult business. It requires a tremendous amount of patience. And I think a lot of people would agree that the trading environment in recent times has been somewhat difficult. This is not at all surprising, since we are in probably the most complex wave of this diagonal. If we do get this double zigzag down through the first or second quarter of next year, each leg after that should be pretty easy to deal with, because they should be straight up ABC zigzags for the wave 3, for the wave 4, and the wave 5. And the wave 5 is highly likely to end somewhere in that Fibonacci target range that I had showed you earlier. And many times it would slightly throw over a line extending from the extremes of 1 and 3. So I think trading is going to get easier starting after the end of this next 4.5-year cycle trough. We're expecting in the first or second quarter of next year. But between now and then, it's going to continue to be a bit rough, and I think we're going to have a recession in there. Very quickly, I also want to show you here's a NASDAQ daily. My wave count at the time on the NASDAQ, this was starting right as the NASDAQ was starting to break to the upside. It was looking for a move up in the NASDAQ through approximately June 8. So the data that I sent this out to my subscribers was April 16. April 16. Well, since then, we have seen that strong move up into mid-June, but it hasn't, as strong as it's been, it was so late in developing that what we ended up getting was some extreme behavior, some odd behavior in the markets that started that really took up the entire month of May and June. Here's my S&P chart that I sent out to subscribers on June 11. As you can see, I had changed my count to the diagonal count by then. I'd been holding that as a alternate, but somewhere in mid-May, I decided to change to this count, and I had showed that target of 4360 on the S&P, and that ended up being slightly overshot, but we're back below that now. And also on the 14th, no, yeah, on the 14th on the ES contract, I was showing that the DSI, the Daily Sentiment Index, had reached 88 on the ES contract, had reached 88. That is an unusually high reading for the DSI. So Daily Sentiment Index is a rather expensive subscription from Jake Bernstein that very few individual traders can afford to subscribe to. It's mostly subscribed to by institutional traders, and that number that it gives is the percentage of retail traders that are currently bullish. And so almost all of retail had, by the time we got this spiky move to the upside, had become all on one side of the boat. And so let's look back at the DSI. And so for that, we'll go to my sentiment screenshots. I showed these last time at the hub, and this is a proprietary sentiment conditions chart template that I use on all futures contracts. And what it does is it compares the positioning of commercials to retail. And there is something called a perfect storm that can develop in sentiment. The last perfect storm we had, I call it a perfect storm, occurred as we moved down into that October low of last year. The DSI, there was for a moment there, just prior to that low, there was only 5% of retail traders that were bullish. And at the low, only 9% were bullish. However, the commercials have generally been heavily long. That's these green zones. The fastest acting commercials, measurement of commercials I use is commercials as a percent of open interest. That's a Larry Williams idea. It kind of speeds up the reading of what the commercials are doing. But the longer term positioning of commercials is shown by the 6-month look back and the 12-month look back. So at these lows right here, commercials were still in a green zone as on a 6-month look back and a 12-month look back. And that means that they were about as long, as bullish as they had been at any time in the last 6 months and at any time in the last 12 months. So they were bullish. The commercials were bullish at that low. Retail was deadly bearish. That is a perfect storm of bullish sentiment. That's what we look for here at Elliott Wave Plus, and our premium plan subscribers get to look at almost 30 futures contracts, and this exact template on almost 30 different futures contracts, ranging from stocks to bonds to commodities and currencies. So what happened in late March? Well, we had the commercials getting heavily long again, and the retail had just come off of lows of 15 and 16. That was a perfect storm of bullishness. And so we've been moving up. But what's happening now on the S&P? Well, commercials are all of a sudden showing that they want to hedge. And so they're coming off of extreme readings at the same time as we got a 91 DSI on the ES contract. On June 15, one day prior to the top tick, retail's 91% of retail traders were bullish. That is a rarefied air when it comes to the DSI. Let's look at the last time we got DSI readings like that. Well, we got a 93 reading in November of 2021. So if you look back, you'll see that the S&P actually didn't peak until January, early days of January of 2022. So we got this 93 reading here, and just as a few days prior to the peak, we got an 88 reading. But when you get a reading above 90, that may not be the most perfect timing signal in the world, but it is a warning, and it's a good one, because the stock market, from the time it showed a 93 reading on the DSI to the time it topped, it only had 2% more upside. And so what this indicates is, and I've seen it happen over and over going back years. I've been subscribing to the DSI for years and years, is that when we saw that 91 here, that may not be the exact top tick this year, but it's a definite warning sign that there's very little upside left to this market at this time. And it takes usually months for the market to work off that kind of froth. Very quickly, I want to show you a couple of other charts that have been suggesting that we are very likely near an interim peak in the markets. This is the black line is the RSP. That's the equal weighted S&P, whereas the purple line is the market cap weighted ESP. And you can see that ever since mid-March, that low that occurred in the S&P on March 13, these two have been narrowing, and then for the first time in years, really first time since the all-time high in 2022, we have the market cap weighted S&P moving higher than the equal weighted RSP. And by the way, that overlay, I've started the peak of each of those items, the equal weight RSP and the market cap weighted ES. I've started them on the same date at the same level, January 4 of 2022. So we have this, when they talk on TV about this being a very narrow market, that means the breadth has been lousy. In other words, very fewer and fewer stocks are managing to hold the market up. And we know what those stocks are. They're the FANG stocks. And I'll bring over this article from the internet by this Rocky White. It was published on June 7. And he's talking about this breadth. And I've taken the most recent periods of really terrible breadth from this article, and I put them on my S&P weekly chart. So according to that article, these are the last few times we've seen poor breadth. We saw it leading up to this peak in October of 2018. We saw it leading up to this peak that occurred just prior to the COVID crash, or that huge 38% smackdown that occurred over only a 5-week period back in March of 2020. We had poor breadth here, but that ended up not being as meaningful, but it was meaningful. You know, the market moved sideways for a month, 6 weeks or so. And then we saw a very poor breadth leading during the fifth wave of that zigzag up into the all-time high. And now we're seeing it again now. So it's not, the poor breadth is not a perfect indicator that we are at a or near an important peak, but it has been pretty good. So that poor breadth is not a good sign for the markets. And then another thing I wanted to show, and I started showing this last week, is that a lot of people think that the Fed micromanages the stock market. And this is proof that they do not. I showed this last time quite a bit. And so go back and look at the recording from February. But these raises or whether they go unchanged have had very little effect on as far they've been worthless as far as trading the markets. Like you look at these last several raises. Here's one they raised and the market went down for a couple of weeks. They raised, the market went down for 2 days and then rallied for a couple of months. Here's one where they raised, it was 1 day after a peak and the market just continued down. Here's one they raised, the market went up 1 day and then went down for a couple of months. Here's a raise, the market went down for 2 days and then continued up. Here's a raise and the market went down for 1 day and then continued up. And then most recently, they unchanged, which the market, I think, was looking forward to them to, to quit raising. And they thought, and the market was under the opinion, if you listen to mainstream financial media, that would be a clue that the market would be free to move forward up from there. Well, it moved up 2 days and then it's been very weak ever since. And a much more effective indicator during all of this has been sentiment. And the fact that we got a 91 DSI right here was much more important information than all this Fed speak. The other item that I wanted to show is how odd, some extreme odd behavior that we've seen recently in the markets. This shows in black the S&P, in red the NASDAQ, in orange gold, and green is the inverted US dollar index, and purple is bonds. And you can see the very tight correlations that have been underway for going back quite some number of quarters. And all of that, with those correlations were working fine until about May 9. And on that date, the black line, the S&P, refused to go down with everything else. Also, the NASDAQ actually started its rally in late April. And both of those continued higher, really against the grain during the entire month of May. Everything else that had been correlated with, the correlation just ended abruptly on approximately May 9. Gold moved down, bonds moved down, and the US dollar was moving up. So remember, this green line, the US dollar is inverted. Then they all kind of moved back into correlation between May 25 and June 16. So the correlation appears to be back in place, but that's not good for the market because now they're all moving down together. So I wanted to show that as well. One other quick thing I'll show before I finish up here with the, because as Jody had mentioned, she runs a tight ship around here. So I wanted to show you on bonds another warning sign of a significant peak that of how significant this June 16 peak may end up being. And for that, we're going to look at junk bonds. So this will take just a second. I know I've only got 1 minute left, Jody, so just take a sec. There's lots of things I didn't show you during the webinar here that I had intended, but you can only do so much in an hour. So This is HYG junk bonds, and the overlay is the purple line is the S&P. And you'll notice that when the junk bonds are moving up, the S&P moves up. When the junk bonds are moving down, the S&P generally moves down, and that general correlation is held beautifully until very recently, in starting in about April. And you'll notice that what junk bonds has been doing has been carving out a triangle, and it is very likely a bearish triangle because I've done a Hearst on it, and Hearst is bearish from mid-June down into, once again, the first quarter of next year, late first quarter of next year. And whereas the S&P magically was able to rally very strongly, I think that was probably a terminal thrust out of a triangle. This is trouble for the stock market. I think it's another indicator that the top we just saw might be the peak for the year. So, Jody, what happens next? Oh,
This is a time when I thank you very much because I love your research, Sid. I'm just in awe of what you do. So Sid showed what he offers. Please check it out. You will be getting emailed that page, elliottwavehub.com/forecasting events with all of the speakers' offers on the page. And I just want to thank you. You've done a tremendous job as always, and I just love having you at the Elliott Wave Hub event.
Oh, and I forgot to mention my offer, and it's the same as last time. If you've never subscribed to Elliott Wave Plus, to any of my services before, I will refund 50% of your first month. To get that, just send me an email, sid@elliottwaveplus.com. That's it. Thank you.
Thank you, Sid.